Distinguished speakers, dear Claudia Buch and Verena Ross, dear colleagues, students and guests, I am delighted to welcome you both here at the Hertie School and the Henrik Enderlein Forum, in particular in this space or online if you're following us on a screen. My name is Cornelia Woll and I'm the president of the Hertie School. It's a great honor for our university and our Jacques Delors Centre, together with our partners at the Jacques Delors Institute in Paris, the Global Policy Center of IE University in Madrid, and the Single Market Lab in Rome, to host two of the most distinguished and influential voices in European financial market supervision, Claudia Buch and Verena Ross. Claudia Buch is chair of the European Central Bank's single supervisory mechanism, which is in essence the head of the banking supervision since 2024. To this role, she brings a wealth of experience at the intersection of academic insight and practical supervision. She served as vice president of the Deutsche Bundesbank for almost a decade, was a member of the German Council of Economic Experts, and held professorial positions at the University of Tübingen and the University of Magdeburg. Her research on banking, systemic risk, and international finance makes her uniquely positioned to speak to the evolving role of banks in the European financial architecture. Verena Ross has been the chair of the European Securities and Markets Authority since 2021, building on her earlier role as its first executive director. Under her leadership, ESMA has reinforced its mission to safeguard financial stability and investor protection while pushing forward the integration and efficiency of EU capital markets, a cornerstone for achieving the goals of the Savings and Investment Union. Previously, she held senior positions at UK's Financial Service Authority. She's a trained economist and started her career at the Bank of England. So I'm barely exaggerating when I say that the stability of the European banking and financial markets depends on these two women. And to have two leading figures that are shaping the future of Europe's financial landscape here with us today is a true privilege, but it is also a powerful signal. It reflects the increasing recognition that strong and integrated financial system, one that brings national borders and one that bridges national borders and mobilizes European savings and reserves more effectively, is essential for our continent's prosperity. This conversation could not be more timely. In March, the European Commission published its communication on the Savings and Investment Union, which serves as a roadmap of tangible proposals aimed at finally moving the needle on a goal that has long been on Europe's to-do list. At the same time, Germany now has a government that is explicitly committed to advancing this agenda, a development that adds a welcome momentum to the political process. Today's event also continues a series of stimulating events on Europe's economic future that we've been proud to host at the Hertie School together with the Jacques Delors Centre over the past months. 6 months ago, we hosted Friedrich Merz and Enrico Letta for a discussion that emphasizes the strategic importance of a single market and the urgent need to deepen financial integration, not as a technical exercise, but as a fundamental pillar of Europe's long-term competitiveness and prosperity. During her visit to the Hertie School 2 weeks ago, Christine Lagarde called on Europe to seize the moment and reinforce the international role of the euro by deepening and integrating EU capital markets, among other things. These are no longer abstract ambitions. They are now framed as an urgent call to action, and that is why today's discussion is so critical. We are eager to hear your views, not only on what needs to happen, but also on how we can make it happen. Which measures should take priority? Where are the political opportunities and the stumbling blocks? How can we as academics, practitioners, and policymakers help to build the necessary consensus? These questions are very much at the heart of the Hertie School's mission, and they lie at the core of the Jacques Delors Centre's work, combining academic rigor with policy relevance and contributing to some of the most pressing debates on shaping Europe's future. Before I hand over to the Jacques Delors Centre's co-director, Johannes Lindner, I would like to thank him and his team for making yet another high-level policy conversation come to life. I do not know if everybody in the audience appreciates how rare and exceptional it is to host the two leading chairwomen on financial supervision in Europe in one room and the president of the European Central Bank in an interval of less than a month. But I am mighty proud. It may help that you have the central bank enthusiasm of Johannes Lindner and the financial supervision expertise of Sebastian Mark at the Jacques Delors Centre, so we can all become acquainted with the central role money, banks, financial markets, and the system's infrastructure plays in politics and in our daily lives. The Jacques Delors Centre not only has all the technical expertise, it also has a dedicated team whose tireless efforts behind the scene continue to make these events not just possible, but impactful. Today's event would not have been possible without our partners at the Jacques Delors Institute in Paris, the Global Policy Center of IE University in Madrid, and the Single Market Lab in Rome. So thank you also for making this a wonderfully European project with our online viewers. So once again, thank you all for being with us today. We look forward to a thought-provoking and forward-looking discussion. And Johannes, the floor is yours.
Yeah, thank you very much, Cornelia, for the kind words, kind introduction of our two guests and the topic. And I'm really delighted and happy to have you both here. Indeed, President Lagarde was here 2 weeks ago and struck a very optimistic note, saying the European leaders got the message. And if you look back at the March European Council, and I did so, it's very clear. And allow me to quote at the beginning. It is of paramount importance to create a truly integrated and deeper European capital markets by achieving the capital markets union as a matter of urgency and completing the banking union. A genuine saving and investment union will help channel hundreds of billions of euro of additional investment to the European economy every year, helping to boost the EU's competitiveness, strategic autonomy, and economic security. I think it couldn't be clearer. This is a top priority. Now, we want to unwrap this in more detail and also speak, as Cornelia said, about the concrete action that is needed to achieve that goal. And we do this in 3 rounds. I want to briefly speak about the rationale for saving and investment union, then about the unique combined perspective of banks and capital markets, and then turn to concrete policy actions. And then I really very much count on you, because then I would want to open up to the audience as well as here in the room as well as online. Now, let me start with the rationale. And the new name of Saving and Investment Union points to the sort of fundamental analysis underlying these 2 projects in a way. So Saving and Investment Union says there is a mismatch between the savings we have and the investment needs we have. Basically analyzing that on the savings side, the European Union, or savers in the European Union, do save more than in the US. In fact, if you look at the disposable disposable income in Europe, there's a saving rates about 15% versus 8% in the US. And so a third of that savings are held in cash and unyielding or low-yielding deposits. On top of this, 300 million, at least until very recently, is going outside the European Union. It's not invested here. So these savings go predominantly into the US. So on the savings side, in a way, not optimal use. And then if you look at the investment side, and here I can quote the Draghi report, we have about 800 billion of additional investment that's needed for the green transition, the digital transition, and defense purposes. So in a way, there's a strong need to mobilize private capital. So these are the 2 fundamental problems, and this is sort of behind the Saving and Investment Union label. And union, of course, because as the key instrument to address this mismatch, the underlying assumption is that if we integrate more, we have a stronger development of the financial sector and thereby also stronger mobilization for these investment needs. Now, my key question to both of you, in a way, do you share the analysis? Do you think that more integration leads to more development and thereby the addressing of the investment needs? Is that the right analysis? And I start with you, Claudia.
Well, thank you very much for the question. And first of all, thank you very much for having us here. So we felt very honored by your introductory remarks. And I would also like to welcome the audience here. It's really an honor for me to speak in Germany about these issues. I think it's the first time since I took office as the chair of the Single Supervisory Mechanism, the SSM. And I think actually the lessons that we can learn from the banking union and from creating the single supervisory mechanism, a European supervisor, are actually very relevant for the debate that you have mentioned. Because we have, I mean, in principle, if you ask an economist, are there benefits of cross-border integration? Of course, everybody would say yes. I mean, if savings and investment can be allocated to their best possible use, if we have integration, this is good for productivity. And this is also good for the consumer because we have more variety, we have more competition, more choice. So the same arguments you would make for trading goods and other services, you would also make it for trade and financial services. But in that sense, of course, the Savings and Investment Union is critical, and I think we'll come to that because we still have many barriers to cross-border integration. But now for financial markets, there can also be a potential downside. So if you have too much integration, too much excessive risk-taking, you also have risks that cross borders. In very intensive competition can actually increase the incentives to take risk. And this is why we regulate financial markets, not to prevent good growth opportunities, but to make sure that the growth opportunities are reached in a sustainable way, that the cross-border capital flows are sustainable and there's not too much risk-taking. So I think this is something one always has to bear in mind. And I think this is particularly important for Germany because Germany has been a net capital exporter for a long period of time, so a large share of net foreign assets relative to GDP. So I think it's really essential for Germany also to make sure that we have global financial stability, and we are contributing part of it with the banking union. Let me maybe just give a few facts, if I may, on what we have achieved with the single supervisory mechanism. So we clearly saw with the global financial crisis, the European sovereign debt crisis, that the negative effects of cross-border integration that I mentioned earlier have come to materialize. So there was excessive lending, banks were undercapitalized at the time of the global financial crisis, and this has changed quite significantly. So the capitalization of European banks since the global financial crisis has almost doubled since the single supervisory mechanism was put into place. There was still an increase, but most of the increase happened until about 10 years ago. Non-performing loans, so this was a big issue in some countries in Europe, in some countries reaching up to 50% of the total loan portfolios have come down significantly. They're now around 2%. So these are big achievements, and it was mentioned at the beginning that it's the two of us being in charge of financial stability. No, it's actually a big team in the ECB, and we also do this supervision of European banks in very close coordination and cooperation with other national competent authorities in Europe. And I think this is also a bit the secret and the success factor behind the single supervisory mechanism, that of course the supervisory power, supervision, direct supervision over the largest banks in Europe, that rests with the ECB, but the national competent authorities supervise the less significant institutions, and also in supervising the significant ones, we closely cooperate, and I think this is really important to sustain the system and make sure that banking benefits to growth and stability, but that we don't have the undue risks that might also happen if we don't have a good regulation and supervision.
No, also from my side, a big thank you for having us here today. It's a great honor to talk to and be together with Claudia on this podium, because I think it's such an important topic. Savings and Investment Union, to my mind, really is the opportunity and the necessary opportunity to now grasp to really make a difference to the European capital markets. And as you rightly said, Johannes, I think there are significant savings in Europe. We are actually very good savers, But the problem is that a lot of that potential is not actually being productively invested to ensure that there is the adequate diversified funding going to the companies in Europe that will actually guarantee our future growth and prosperity. So it is, and that's why I quite like this saving and investment union concept, because it really tries to explain that link between having the savings and using them and making sure they're invested productively in those companies that will actually be able to grow and develop the European economy. And what are the barriers? We are still living, we are supposed to be in a single market, but we all know that certainly when it comes to capital markets, there are still enormous amounts of fragmentation and barriers. And I very firmly believe that if we don't start tackling that and making sure that actually our capital can flow freely to the most productive investment opportunities, making sure that our markets actually have the deep liquidity that is necessary to attract companies to list on the public markets, that allows people to actually invest in products that are European-wide and that actually can reflect the kind of opportunities and risks that Europe represents. I think if we don't tackle those type of issues, we will not be able to put Europe on firm 2 feet and develop in the future. And there, I think there's a lot we can indeed, in some areas, learn from what the SSM has already achieved and done. We, in the capital markets area, our regulatory and supervisory system is still more fragmented. It will probably also remain more fragmented. It's a much more diverse set of different market players in different sectors interacting and cooperating in the financial markets. We really, as ESMA, we look from the investor protection all the way to the efficiency of the market and the financial stability. It's a wide remit. And that means we really need to look at where can we focus our attention to make sure that not with one magic wand, but with a number of key initiatives, we can really make a step change. And I fully share your view that there seems to be the political dynamic to support that at the moment. We hear a lot of positive messages around that, and I very much hope it reflects the urgency that Europe has to have an effective capital market also in the current geopolitical environment.
One of the key innovations, in a way, of Saving and Investment Union is not only this name that links the sort of to the main theme of matching saving and investments, but it's also to bring banking and capital together. I mean, we all know the underlying number saying that corporate funding in Europe is 70% or over 77% bank-based, while in the US it's over 70% capital markets-based. And the sort of more simplistic perspective was we need to be like the US, we need to be reaching that US number at least a bit more. Now, Saving and Investment Union now tries to combine banking and capital markets in a more holistic perspective. Where do you see the sort of synergies, or where do you see the advantages of looking at this a bit more together, banking and capital markets together? Maybe this time I start with Verena, and then I pass on to you, Claudia.
So first of all, I think what I think is important that we don't look purely on a sectorial basis in isolation. I mean, banks are also very important players in the capital markets. We also, I think, need to look at the fact that Europe is not like the US, and therefore we will always have a different market structure. And I also think that has its benefits, and we need to build on that rather than now trying to blindly copy something that probably won't work in the same way anyhow. So from that perspective, I think that fact that we are looking at how can we strengthen the banking union, which still has some steps to take, but also how can we at the same time drive forward the capital markets union, I think is very important. We need strong single market in banking as much as we need a strong single market in capital. And the two should be interconnected because ultimately it all plays in the same system. And so the stronger each of the components are, the stronger we will be, I think, together. On top of that, Claudia mentioned the issue of risk. the issue is that, we also hang together in terms of financial stability. The issue is that with banks being active on capital markets, how our post-trading system works, how do we make sure we have the right balance between banking capital, private capital, and other financing opportunities. All of this has to hang together, and we need to look at it holistically.
Maybe, Claudia, also to add the question of what can we learn in a way from the banking union agenda for the saving and investment union.
Well, let me first maybe also explain why the two things really go together so closely. I mean, if you somehow start from the funding structure of firms, no? So I mean, there's a continuum of how firms fund themselves. Maybe if they're in the startup phase from internal sources, then maybe venture capital, bank lending. At some point in time, they go to the market. So I mean, there's everybody who's. I guess you're teaching this also here, thinking about the corporate finance. That would be the pattern one would observe. Now, if we're thinking about this initiative to also promote the single market for corporations, it would be odd to think that once you expand across Europe, then the funding sources are somehow segmented in countries. So in that sense, I think it's key that also the financing sources also operating in an integrated market, because we certainly have a lot of bank finance in Europe, and there's a lot of reasons for that, preferences, historical reasons, whatever. But clearly we need more equity finance to finance long-term investments, very risky investments. So in that sense, I think there needs to be a smooth continuum. And actually, many of the barriers that Verena mentioned that we have for more integrated capital markets are also very relevant for the banking sector. If you think about insolvency legislation, so this has been one file which has been discussed a lot. Can we find some minimum harmonization so that when you go across borders as a bank or as another provider of finance, that you don't have to deal with many different insolvency regimes, taxation. I mean, there's many other examples you can give. So in that sense, I'm also optimistic that we now have the political momentum to actually move on. But I think it also, maybe that's the lesson from the banking union and from the SSM, it also needs to be put into practice, and that requires sometimes tough political decisions. So I think we need to move from this point of understanding what the issues are to actually putting this into practice and removing the barriers, and that's very hard.
And that brings me, I think, directly to the question of what are now the concrete policy priorities that we can achieve. So which are sort of optimizing on the impact as well as are feasible. And I would want you to, in a way, pick two that would combine this impact as well as the feasibility. And if I could add one additional question, also, where do you see the role of your own institution in pushing the debate and in making exactly what you said, the progress that we need, that we move from consensus or from political declarations to actually concrete actions? And maybe, Verena, I start with you. Two actions, and what's the role of ESMA in that?
No, first of all, coming back to the earlier question, I just want to say, I mean, clearly, the SSM and the creation of the single supervisory system for banking is a real inspiration. And I think we also need to learn lessons from that as we look at, are there areas across the wider range of the capital market supervisory responsibilities? Much will clearly remain at national level, and rightly so, but I think are there areas where it makes sense to maybe go to the European level for the more systemic market infrastructure type players. So I think it's something that there's a lot we can learn, I think also about how we make that happen on the ground. So I think it's very good to have those exchanges and to share the experiences. In terms of the policy measures, it's a really tough one, because if you look, for example, at ESMA's position paper of last year, we, as securities markets regulators, basically put forward 20 recommendations and saying there's not one single measure, one single one that will kind of magically somehow transform us to having a fantastic working European capital market that is united. So we need a number of different measures. I think for me in particular, we need to look at the kind of, in a way, demand side. How do we make sure that actually there is the ability of investors to engage in capital market, either as retail investors through their long-term financial planning or through collective investment via occupational pensions or private pension schemes and things like that. I think it will be important to work on that, to try to think about how we can achieve that. A lot of that will depend on national measures as well, because a lot of it is linked to pension reform, to taxation, to issues such as that, which are not managed at European level, which is why it's so important that national and European efforts are moving in step. And I think the other thing, maybe a bit closer to my heart, is clearly looking at how can we create an effective and efficient regulatory and supervisory system that actually underpins that single market. Because we have, I think, breaking down of some of the barriers is incredibly difficult. But I think if you're not tackling some of the framework in which we are actually working, it will be very hard to make those steps. And so trying to also look at that efficiency of the regulatory and supervisory framework is very important as well.
Can I, before turning to you, Verena, can I maybe ask you two questions on these two priorities? One is on the saving dimension that you mentioned. There has been this initiative by the 7 member states in Paris, coordinated by the Trésor and the French government, to go ahead with a sort of European savings label. Do you see that's the way forward? Is that something that you would say is the avenue that should be pursued more, both in terms of the focus as well as also the fact that there is a sort of an avant-garde of some member states going ahead? And the second question, and it ties a bit to my question of what's the role of ESMA, is that some of the skepticism on moving ahead with supervision is also around the governance. And we talked quite a bit about the governance that was created when the SSM was set up. So what would you, maybe also a bit self-critically say, like, would ESMA, just giving more supervisory power to ESMA, would that work without governance reform?
So let me first talk about the initiative of the Finance Europe label, which actually grew out of a kind of lab idea that the Spanish government originally put on the table. And indeed, this is the first exemplification of a number of member states coming together. I think it's a very interesting initiative, and I think what we need at the moment is thinking outside of the box and trying different things also. So I think from that perspective, it's a good initiative. At the same time, I think we need to also make sure that we create something that genuinely works across the European Union. And for that, we need to continue to also work looking at other potential areas that could support that, whether that's a savings account, whether that's a kind of cross-European label or product. It's not easy to design that. It's not easy to find the right solution, but I think we should definitely not rule anything out at this time. And I would therefore be supportive of any initiative that pushes us in that direction and that combines, as I said, that national with the European kind of spirit, basically. On the supervisory side, there has been a lot of discussion about, how can ESMA play a bigger role? I believe we can. We are already a day-to-day supervisor for certain parts of the financial sector. Actually, we started 3 years before the SSM was even created on credit rating agencies. But that's maybe not so well known that we actually are a functioning supervisor with our current governance system as it works. So it can work in a board of 27 and finding common solutions and actually relying on the ESMA staff for the day-to-day supervisory responsibilities and so on. Key decisions in the board, I think that works very well. But clearly, if we would see a significant enhancement of the ESMA's supervisory powers, and let's say very clearly, I would argue for some of that. I'm not kind of arguing for ESMA takes all over. I don't think we are there, and I think it's very important that we target where does it make most sense to move from the national level to the European level. And for example, that would be in the market infrastructure space for the big cross-border systemic market infrastructure trading, clearing, settlement, but also in some of the really digitally cross-border type areas where we have just set up, for example, in crypto asset services, a system where 27 supervisors are trying to get to grips with a new industry. That's just not very efficient to try to do it in that way, and it leads to cross-border regulatory arbitrage opportunities. So I think there are opportunities. If there's a significant shift in the additional supervisory responsibilities, maybe we should, and our co-legislators might want to look at governance changes. There are clearly models of the SSM, of other European agencies and authorities that are differently structured in the governance. But I have to say, actually, for what we do at the moment, and it has real advantages of having the national supervisors around the table that buy in and are part of the solution and actually decide collectively on where and how to focus our supervisory efforts. So I would say the governance mechanism works pretty well as it is at the moment.
Thank you very much. Your 2 actions on banking union.
Well, it's relatively easy, actually, because the banking union has 3 pillars. So I spoke about supervision. The second pillar is resolution, and this is a big achievement compared to what we had prior to the crisis that I spoke about. Because I mean, in banking, like in any other sector, exit from the system should also be possible. Now we do everything that we can to prevent banks from failing, but we can't. If in case it happens because of exogenous shocks, whatever, we need a resolution mechanism, and a lot has happened actually in the past 10 years. So the single resolution mechanism also celebrates its 10th anniversary this year. A lot has happened. We have industry-financed funding for resolution. We have new mechanisms. So we have bail-in capital. We have an institutional framework. And that actually is very good for supervision, because the better, the more credible the resolution mechanism is, the better are the incentives also of the banks in the going concern to avoid getting to the resolution state. But there are gaps, and there's actually one you asked, so how concrete can the proposals be? There's actually a very concrete proposal that came from the European Commission, which is called CMDI, Crisis Management and Deposit Insurance, which aims at closing the gaps in the resolution framework. Basically, I mean, in a nutshell, the file is complex, but in a nutshell, making sure that also mid-sized institutions could fall under resolution, and that sufficient funding for these resolution cases would be available. So this has been discussed intensively. It's currently in the trilogues in Brussels, and we very much hope that a solution is found which is close to the original Commission proposal, because we thought that was really workable, and it would also, as I said, would also be good for supervision and overall for the stability in the system. I think there's sufficient safeguards in the framework that would also ensure that moral hazard is being contained. So I think that's a very concrete proposal. There's a second proposal, the third pillar of the banking union. This is European deposit insurance, an issue which is discussed very intensively in this country, but also in many other countries. I would say that 10 years on, 10 years after having the single supervisory mechanism, a significant reduction in risk, and a stable financial system, a resilient banking sector, now is the time actually to move on also with these 2 files, resolution and European deposit insurance, because we don't know what the future holds in store. No, we all hope that there's no negative shock hitting the system, but I think in order to, but moving these files forward, making the system more crisis-proof, I think it would really be good for the stability of the system. I mean, just one number when it comes to deposit insurance. Right now, we have only 2% of deposit holdings in Europe are cross-border deposits. So for me, this is also a signal that we don't have sufficient competition. This is where we started with integration. We don't have a fully integrated market for deposits for the citizens, because people might be concerned that their deposit protection is different when they hold deposits abroad. So harmonizing this, having European deposit insurance would really be beneficial, I think, for the system as a whole.
Can I also ask you 2 follow-up questions that are difficult ones? I appreciate that one, but they're a bit more political. So the first is the issue of the resolution pillar. How worried are you that we don't have the backstop yet, so that the ESM treaty that is in a way ready and ratified by most member states is not yet ratified in one of the member states, and thereby we don't have that backstop that is important to keep and to protect in a way the credibility of that fund. And my second question again is also more in the realm of politics, is to what extent do we still have a trust issue in banking union? When I look a bit at the discussions around UniCredit and the takeover from Commerzbank and some of the sort of immediate reaction that we saw in this city or this country, do you see, is this a sort of an example of that there is still some political resistance and a trust issue in a way into banking union?
Well, as to your first question, you said there's we had two wishes on our list, and you mentioned now a second and a half one, if you want, on the ESM treaty. I mean, this is a political decision that needs to be taken, and we've always said that there's more elements to make the whole system crisis-proof, and the ESM treaty, the backstop is one element, liquidity and resolution is another element, and we've always said that it's this whole spectrum of political decisions that needs to be taken. As to the second question on trust, well, first of all, and I should always say this, I don't comment because you mentioned names of specific institutions, so anything I say is not related to any of these institutions. And I think maybe this is also one of the reasons why we're here today. I think it's important to explain the system and how it's actually working. And so within the SSM, we have a clear role when it comes to the approval of qualified holdings procedures or mergers in banking, and that role does not differentiate between domestic and cross-border mergers, because we live in a banking union. So in that sense, borders don't play a role. We had many other reasons why we argued that we still have insufficient integration, but just taking that aspect, mergers and acquisitions, national versus cross-border, we have the same criteria that we look at, and it's very public what it is. It's about prudential ratios, it's about governance mechanisms. So I think it's important also to remind that debate that what is the role of the SSM? We apply the same standards across countries. We do this actually in a very trustful way with the other authorities, and so the other supervisors also sit around the table. So I think that helps. We have a role. It's a limited role, but it's there, and I would say that it's working well.
Thank you very much. I would like to open up to the audience, and I see two questions. Okay. Then maybe we start with already mentioned Sebastian Mack, our Policy Fellow for Financial Markets.
Thank you. Hi, my name is Sebastian Mack, and as Cornelia already kindly introduced me, Senior Policy Fellow at the Jacques Delors Centre. I have a question on something that we haven't touched upon yet, which is the EU simplification agenda and its interplay with the Savings and Investments Union. Well, due to pressure from the Trump administration, BlackRock and many other asset managers in the US have abandoned their green investment policies, and we can now observe in recent investment flow statistics that more and more capital looking for sustainable investment is actually redirected now to Europe, which is the ultimate goal of the Savings and Investments Union, and therefore I think very welcome from a European view. However, in this very moment, the EU is about to dismantle its sustainable finance framework. As you know, in February, the Commission proposed the so-called Sustainability Omnibus, arguing that we need to cut red tape to maintain our competitiveness. And the Commission proposals contain far-reaching reforms that reduce transparency on climate risks and weaken also corporate responsibility for people and the planet. As you know, the European Parliament and EU member states now want to go even further. President Macron, Chancellor Merz call on the EU to even drop the corporate sustainability due diligence directive entirely, which, among other things, requires companies to bring their business in line with the Paris Agreement. So against this backdrop, I would like to know whether you think that the omnibus package jeopardizes Europe's leadership in the field of sustainable finance, and ultimately undermines Europe's attractiveness for sustainable investment. And last but not least, I would be interested in your take on the implications for financial stability. So if banks, investors, and financial supervisors don't get the data they need to assess climate risks, could this provoke another financial crisis? Thank you.
It's a long and a difficult question indeed. So let me try to give it a start, but I'm sure Claudia will come in. So I think, first of all, if I look at the overall agenda for simplification and burden reduction, I think it's an important agenda that certainly we all need to be conscious of, because we are in an environment where we need to make sure that our regulatory system actually is efficient and effective, and for that, you know, we need to look at the complexity of some of what we've built over the last few years. But that is about simplification, that's about decomplexifying, that's about reducing reporting burdens, for example. It is clearly, to my mind, not about, you know, throwing the baby out with the bathwater and complete deregulation agenda. I think we would be in danger of kind of undermining the resilience that we've built, and that is important, as we've seen particularly in recent market events. So from that perspective, it's a very important agenda. ESMA is certainly fully committed to play its part. We've already started launching a few ideas about facilitating and simplifying the investor journey, for example, with thinking about, does everyone need all the information to make an investment decision? Can we streamline that somewhat? And so on. We're looking at reporting requirements. And coming to the sustainable finance agenda, I think, again, Europe was very ambitious, very fast in putting out a lot of different parts of the regulatory framework. I also have to say we did some of that not necessarily in the most logical order, because we started with some product disclosures before we had company disclosures and things like that. So I think it's absolutely right to take a step back and say, where does it make sense to readjust, to maybe take a step back to get to the right outcome? But ultimately, at least I was reassured that also the Commission was very clear, the Green Deal, the importance of sustainable finance and a transition is still something that's important in the European Union. And for that, clearly, also it's important that we look now at the proposals from the Commission. The co-legislators will very clearly want to look at what makes sense, what do we keep, how do we make sure that actually ultimately we have the right information, whether for supervisors or for investors, to still make informed choices around sustainable finance investments.
Yeah, very much in line with what Verena just said. So first of all, the simplification agenda, and maybe we can go into some more detail. I think it's critical that we don't take it as a synonym for deregulation. So these are two separate things. Yes, whenever we do supervision, reporting, regulation, there's always ways to kind of step back and see whether we can do things in a simpler, less complex way, and we are all very much open to that. But it shouldn't mean weakening the standards. And I'm sometimes a little bit concerned that these things are not clearly differentiated in the public debate, so that we may end up in a situation where the standards are weakened, and that's certainly not where we should be. So maintaining resilience, the resilience we have achieved, is really key. Now the climate agenda. So we started around 2019, 2020 to ask the banks what are their frameworks for managing climate and environmental related risks, no? And this is our role as supervisors. We need to make sure that banks have good risk management systems in place. And some banks had systems, good risk management systems. Most of the banks did not. So then we worked with them. We had stress tests. We formulated supervisory expectations. So it was a long road to travel together with the banks. And now we're in a situation where actually most of the banks take climate and environmental risks very seriously. They have significantly improved their risk management systems. Not all of them, so then again we would follow up with our supervisory tools. But I think a lot has been achieved in this space, and this is critical because no matter, we are not policy makers, we are policy takers. So no matter what the decisions are that are taken in the political arena, these risks are there and they need to be managed. And very much in line with what Verena said, I think it's critical that also the banks have the relevant information they need to manage these risks, and this is why we said, of course, also for the climate-related reporting, one can improve the system, one can make it more efficient, but one also needs to make sure that the relevant information is there because the banks have actually invested into these risk management systems, and they need this type of information from their corporate clients.
Turning to the next question, our colleagues from the Dutch Embassy.
Thank you. Robert Sieben from the Netherlands Embassy here in Berlin. I would like to my question would like to go back to the beginning of our discussion, which is matching savings and investments. Savings are normally done at banks, whereas investments are done by banks, but also very often by what we call private investments, so investment vehicles. And there you see a difference between the European and American capital markets. As you said, 77% is bank finance, whereas in the United States, 70% is through equity. Hypothesis, we would like to be more like the Americans and have more investment through equity. What can we do to make risk-taking more interesting for those people that now put their money in a savings account where it sits and may not be as productive as it could be? That's one question, very basic question, and then a completely different one. How likely or how achievable would be a 28th regime? That's to say that banks and investment vehicles could opt out of national regimes and opt for a European regime, which would then be the same for the whole of the European Union.
Very good questions. Verena, do you want to start with that?
Yes, happy to try. I think on the question of how do we... sorry, let me start again. I think we need to be conscious that we have a different market structure and we have a different societal environment than in the US. And I think that will also remain the case. So I think, as I said earlier, we should not just try to blindly copy a society and a system which just is quite different to Europe. We should build on our strength. But as part of that, indeed, I think a more diversified structure where companies can also go to private investment vehicles, other ways of actually trying to find funding for the startups, the innovations, the risk capital that they need at different times in their life cycle is extremely important. And we are in Europe at the moment weak in this area. If you look at the comparison, indeed, venture capital, private equity is still very underdeveloped in the European markets. And it's something that is important. We also, I think, and you coming from the Netherlands, we need more institutional investors. I mean, the pension funds, for example, are really important parts of the investment environment to actually have the core investors that are willing long-term to invest in some of the companies in Europe that have that ultimate growth potential. So we need a combination of different facilities to make that happen. Maybe on that, I think... What was your second question? 28th regime, sorry. On the 28th regime, I'm not a lawyer, I have to say, but the reality is that we face, as Claudia said, some fundamental issues about basic company law, taxation, and so on. If we could break through that by having the option of a 28th regime, it could actually be quite a game changer. Having said that, we already have a European company regime, which seems not to have made that much of a difference. It's not that many companies that are actually using it effectively. So I think we would need to do quite a bit of thinking of the cost benefit of setting it up and what it would actually deliver.
Yeah, so I think whether or not the structure of the financial system would converge to the US or not, I think this is really something, and you basically said it as well. There's so deep-rooted preferences in society, institutional frameworks, social security systems, pension systems that also shape what the financial system looks like. I don't think that it's desirable to look at another country and to see whether we would copy or whether it would be welfare enhancing to have the same system. So I think what we do very practically, when you mention banks, indeed, most of the savings of households are in banks, but banks are at the same time very closely connected to private markets and to non-bank financial intermediaries. And here again, we take the risk perspective and we look at whether or not the banks can manage these risks well. We've actually just published a blog on banks' links to private markets, which can be very complex. So part of it this could be useful because risks are shifted to parts of the financial system where the institutions can better bear these risks. But there's also a lot of transparency. So this is why we're saying banks need to monitor these risks well. They need risk management systems around it. And I think there's also space for more policy action to bring more transparency into those parts of the non-bank financial intermediation system which is not well regulated. Of course, these can also be insurance companies, but it can also be providers of finance where we, as authorities and also as where the banks know relatively little about the risks that are in these parts of the financial system. So this would be my angle, not to, design a different optimal whatever system, but really think about the practical implications for risk management. And I would also be very pragmatic when it comes to the 28th regime. If it's easier to negotiate what the 28th regime should look like rather than harmonizing more of the national rules that right now impede the integration of markets, well, then maybe this could be a way forward, but I'm a little bit afraid that the discussions around what should the 28th regime look like is also complicated, this discussion. So, but it's not for us to decide, I guess.
Thank you very much. I see two more questions, maybe here.
Thank you so much. My name is Captain Muturaj. I'm a student at the Hertie School. So this question is in parallel with what we are talking about from Capital Markets Union. So this is more in line with understanding the role of crypto assets in achieving savings and investment union today. So maybe I would like to understand the perspective from both ESMA and ECB. So this question is for Claudia. As we know, we have a European framework for crypto assets, which is the Markets in Crypto Assets Regulation, and it's already in the implementation phase. And as we see, there is a lot of traction specifically in the stable coins market. So last week, Andreessen Horowitz issued a report saying that almost $33 trillion worth of international transactions has happened through stable coins. Now, how do you see the role of stable coins involved in shaping the savings and investment union initiatives? Because I also understand that digital euro is a very important step for Europe, and ECB is very much focused on it. Do you see the role of stablecoin and digital euro kind of clashing, or do you see that there is no competition in between and there's a clear winner, which is digital euro or a stablecoin in that matter? So the second question is for Verena. So again, with ESMA, we have guidelines for financial instruments, and I'm specifically talking about the tokenization landscape here in Europe. So we have seen there are clear evidence that, especially for illiquidated markets, tokenization has been a clear winner. And also with SME funding, it's a very big scope. Do you see that, especially because you have already spoken about these 2 points in your panel discussion now? So do you think that tokenization can enable more capital investments into the markets? And is it right time for us to think about crypto markets as part of the savings and investment union? Thank you.
Oh, 2 very technical questions, but thank you very much. I would group it with the last question because our time is slowly running to the end. So please, from the French embassy.
Perhaps slightly less technical, although I'm not sure. One question is perhaps for you, rather, Claudia Buch, on EDIs. One of the arguments that has been consistently advanced by a number of member states, including Germany, is the sovereign bank nexus. Do you from your SSM perspective, perceive it still today as a legitimate argument not to make significant advance on EDIS? And a second, perhaps more general question for both of you: what's your view at this stage on the best way to articulate this SIU agenda with competition policy? I often feel like competition policy is still very much a dead angle, including nowadays in this whole debate. I believe, and I have good reasons to believe, that it's also one of the major political hurdles at the end of the day. What's your view, knowing as well that one of the very seminal ambitions with the CMU back then was to address too big to fail? What's your view, both in the banking and non-banking sector?
Okay, Claudia.
Yeah, so I try crypto too big to fail and EDIS. So let me try to do this quickly, because these are three big themes. On crypto, a lot can be said, and we don't really have the time to discuss it in full. But if you listen to what we said about what is the benefit of a savings and investment union, what is impeding the further integration of markets, of course there's a technical aspect to it. So new technology can of course help to promote integration, but most of the things we mentioned were related to national rules, national regulation and all that. And I just don't see how the developments that you mentioned, how they would overcome these obstacles. So I think it's not, just saying, and I know you didn't say that, but I just simplify this, stable coins, crypto does the trick. No, I think we need to have more integration and also policy decisions being taken towards promoting the single market. At the same time, I see significant risks related to crypto and also stablecoins. So I think MiCAR, the European regulatory framework that we have in place, is very useful and much needed, because we have the same issues related to conflicts of interest, market concentration, high leverage that you can have in these areas. So we need to be very vigilant with regard to these risks. Then to your question on EDIS and the bank sovereign nexus, I mean, we are working and we have worked hard, and also the banks, of course, who reduced the risks on reducing one leg of that nexus, namely the high risks on banks' balance sheet that then also led during the global financial crisis to fiscal bailouts and this was one major reason why the banking union was put into practice, to break the bank sovereign nexus, and we've achieved significant risk reduction. So this is why I was saying now is the time to move forward also with EDIS, exactly for the reason mentioned, that we also break the bank sovereign nexus for the future and don't have this link between banks and the national sovereign. But of course there's more to the equation. There's also fiscal prudence and all that that is also relevant. And then there was a third one which I forgot. Competition and too big to fail, yeah. So again, a lot can be said, but I think we also have now much better mechanisms in place to address the too big to fail issues. So we haven't spoken about macroprudential policies, the additional capital charges for systemically important banks. So there's a lot of differentiation in the regulatory framework for banks which address the systemicness of large financial institutions. There was actually a very nice report by the Financial Stability Board a couple of years ago, which is summarizing the progress that has been made.
So maybe just briefly to add, Claudia has said a lot already. So on the crypto side and tokenization, I think it's clear that tokenizing financial assets is something, or other assets, to be able to trade them in a digitalized world is clearly something that shows significant promise. There have been, for example, the pilot regime for DLT market infrastructure. It's not taken off as quickly as we had hoped in a way, but there are some good examples now. So I think there is a possibility that that will grow, but at the same time, we've also not seen it take off as quickly as everyone thought it would. If you had talked to people 5 years ago, they would have said everything is now tokenized and at T0, same-day trading and settlement. It has not happened. So let's see. I think it's important to continue to see that development, and I think there is promise in actually also breaking down maybe some of the barriers that are coming through, for example, quite lengthy and costly clearing and settlement processes if you go digital and you go DLT. So I think there are opportunities there that can clearly come, and we need to keep fostering that and looking at that. And then on the competition point, I don't have that much to add. I think, you know, you want a capital market system, you want a European capital market that is, on the one hand, competitive vis-à-vis the rest of the world, and at the same time you want competition within it to ensure that you actually have efficient markets that work well. And you need to find that balance. And it's not an easy one, but it's clear that it's one of the areas when you talk about the fragmentation and market infrastructure, the costs that are in the system, that clearly more interoperability, more kind of market infrastructure players coming together has advantages for liquidity, has advantages for a more integrated market, and we should not completely disregard that.
Thank you very much. I'm afraid we need to come to an end. I started with a quote, and I would like to start or to end with a quote. And I read it out, and then I make you to guess by whom it is. I do believe we have a chance to make Europe's economy more stable, to give our business more choices of funding, and to help them expand and compete in the remorseless global market. No one is pretending that progress is always going to be easy, but with the political support I sense and the rapid progress we have already made, I'm optimistic about what we can achieve. By whom and when? If you don't...
A few years ago already?
I think you're absolutely right. It's 10 years ago, 2015, and it's by the then Commissioner for CMU, Jonathan Hill. And we've had Brexit and 10 years of action plan. I think it shows that there is still quite a bit to do. But I think you left us with a note of optimism, and I wanted to thank you for that. Thank you also for the clarity with which you tackled all the difficult questions. For coming, I also want to thank the audience, also the people on the internet, online here. And for those of you that are here, you're very welcome to join us. We have a few drinks here for further discussion bilaterally. And let me also thank you to the team. Once again, a great organization, and thank you very much also to you, Cornelia, for making this possible. So thank you very much, and all the best.
Thank you very much.
Thank you.